Right, well, let's make a start. Welcome, everybody. This is Martin Sherwood and my colleague Christian.
Good afternoon.
Welcome to our post-budget webinar, and this is going to last about 30 minutes. Please send us your questions, and we will try and deal with those in the last 5 minutes of the session. So, let's move on quite quickly. We've got just to draw your attention to the few risk warnings. Everything we say this afternoon is subject to the draft finance bill, which is, we understand, likely to be published next week. So we're working off the announcements made last Wednesday in the budget and the documentation that was published simultaneously. We are waiting for the draft finance bill. We don't believe there will be any substantial or any differences at all, but it is something that I've got to warn you about. We've got a couple of slides here about us, but I don't think you need to hear very much about Enterprise Investment Partners. I believe most of you know us quite well, and that's what we all look like. So we're a team of about 10 going on 12 currently. Anyway, let's move on to the main part of the presentation. I'll hand over to Christian in a second, but broadly speaking, this was a very, very positive budget for the Enterprise Investment Scheme. Well, the Enterprise and Venture Capital Schemes, I should say, so the so-called tax advantage schemes. There were no changes of any substance to things like the rate of tax relief, minimum holding periods, so none of that was affected at all. There was a massive boost given to knowledge-intensive companies, otherwise known as KICs, including a doubling of the annual investment limit to 10 million. So that's really important. Also, investors have got the ability to invest individually up to £2 million a year, provided 1 million of that is investing in KICs. There was minor tinkering of the rules in venture capital trusts. That really was quite small and irrelevant. We can cover it if that's of interest to you, but we don't intend covering that this afternoon in any substance. I think the key thing that we're all focused on was the introduction of what the Chancellor called principles-based test to focus tax relief on higher risk investments, particularly directed at so-called capital preservation schemes. So let's move on to talk about that. Christian, do you want to just handle this bit?
Yes, so I'll, over the next few slides, I'll just sort of cover off the principles-based test, how HMRC will seek to apply this. But essentially, the principles-based test introduces a new condition. It's referred to as a risk to capital condition. It applies across all of the sort of tax-efficient products, if you like, or structures. So the EIS, the CDIS, and the venture capital trust. But it's in two parts essentially. So HMRC, when looking at a company, we'll look at, there'll be two sort of guiding sort of lights, if you like. The first one covers off the objective to grow and develop over the long term. There's already in the legislation a referral to sort of an objective to grow, but this just takes it a bit further in here as well with its reference to long term. The second part is and is obviously the new sort of terminology they've introduced is that an investor and or the way a company operates, it must be subject to significant risk. It could be a loss to capital, and therefore that the investor is exposed to a capital loss at greater than their net return. And essentially what this is alluding to is, what is in the first place the target return of the company and what might be the likely outcome for the investor. But also in targeting a return is an equal and opposite risk or high risk that they could lose more than that net return. So conversely, an example might be, the company has the ability to achieve a 1.5, 2 times return for investor, but conversely, the downside is that they could lose all of their capital, or at least half of their net return. So something like return 50p as opposed to 50p upside. As I said, in applying this principle-based test, HMRC will look at a number of aspects of a company's business plan, and they will look at these issues in the round. That's to say that you may fail some parts of these conditions. So there may be examples where they believe that this is capital preservation or low risk. There may be pointers towards that, but equally there may be more or equal pointers that that capital is at risk and there is a high return, and this is an investment for the long term. So that they would consider all of the issues of a particular offer on a case-by-case basis and come to a conclusion. So that's to say, in short, that you could fail on some of them but still pass overall and get advance assurance, or obviously get EIS compliance passed. The new test, they said the new test will come into force on the date of Royal Assent, which we believe currently is going to be around the normal time of Royal Assent, which is sort of around the early summer, so sort of mid-18, so around June or July. But obviously, I think that may become clearer when they draft they published a draft finance bill as soon as this Friday. So I think they've alluded to the fact that it could be on the 1st of December. What they have said is, from this Friday, when they're looking at advanced assurance applications from companies, they will do it through this new lens of applying the risk to capital condition. So that is to say, advanced assurances that arrive from the 1st of December onwards, but potentially also advanced assurances that they already have and are kind of work in progress, if you like. So again, this is not particularly clear on this point, and hopefully we will get a bit more clarification on Friday or next week how they will be treating with advanced assurance that they've already received. But I believe that probably to work on the worst case scenarios, that it will apply to those advanced assurances which are still in progress at HMRC. So let's quickly, before we get back to the risk to capital condition, just quickly look at some of the improvements they made to KICS, as Martin talked about earlier. Obviously, a KIC is a knowledge-intensive company. The easiest, straightforward definition of that is a company that undertakes significant research and development. What changes have they made? Well, they've extended 2 limits. The first one is the annual investment limit for an EIS investor. So currently that's £1 million per tax year. But what they've said is, if an investor wants to invest in KICS, then they have an additional 1 million per tax year, as long as that's invested in KICS. So beyond 1 million, up to 2 million. Also, they've increased the annual limit that a company can accept in any 12-month period. For most EIS companies, 5 million to 10 million for KICS. So obviously that kind of mirrors the fact that the investor had the ability to invest a further $1 million, but also the company has the ability to accept a further 5 million per tax year, or every 12 months. But importantly, the lifetime state aid cap still remains at 20 million. The other change they've introduced to the KICS and the criteria is around the age limit. I think if you remember, about a year ago, 18 months ago, they introduced this kind of age limit test where at the first point a company can accept venture capital. And for most companies that's a 7-year test, but for KICS it's a 10-year test. It's basically going to give them more flexibility around when that 10-year period starts. So they can choose between either the 10-year period, the first commercial sale that's been made by the company, or they can test it on the company reaching £200,000 of turnover. So it's an either or. So that gives a lot more flexibility, and clearly, it gives the companies that suits better to go for commercial sale the ability to go for that, or equally the companies that have got have made turnover at a later stage of 200,000, they can go for that date. So just moving back to the principles-based test in practice, HMRC gave a number of illustrations when they published their guidance alongside the budget last week about how they will apply the risk to capital condition. So here we've just kind of broken out in two sections what is likely not to qualify and what is likely to qualify. So companies that deploy capital and look for early exits and are demonstrably that process is controlled by a fund manager via a nominee, and equally that's a concern for them. Targeting low returns, and particularly low returns which are capped from an investor perspective, again is a bit of a red flag for HMRC. They've clearly seen schemes where the fund manager has a lot of control. They're targeting very low returns, which consequently would indicate low risk, and also that the investor, even if there is more return to be had, are capped off from having access to that return. Look at other things that they will look at that could be potential red flags is where a company derives significant income from a substantial asset. So large sort of property, freehold properties, large single capital expenditure, things, and they go on to give examples of that. So crematoria, wedding venues, and film and TV asset backed by virtue of pre-sales or tax credits. So again, sort of targeting those investments which are essentially building out large freehold assets where the true wealth creation or value creation is from appreciation of the freehold value of the asset or an alternative use of the asset rather than the trade itself.
Yeah, we had thought, hadn't we, that they were going to attack any freehold-based trade, but that's not at all clear that they're going to do that. So you might have a company, for instance, that was operating freehold pubs, which bought several freehold pubs. So you might have 5 or 6 freehold pubs in one company. It looks to me as if that might well qualify, whereas a much larger single asset like a crematorium or possibly a storage unit, which takes up most of the £5 million within the EIS company, it sounds to me as if that will not qualify. But it's not at all clear that it's attacking all freehold-based operations.
Yeah, and that's very true. So I think that's I think the HMRC and the Treasury recognise that by excluding freeholds altogether, that the baby went out with the bathwater slightly there, and that there are some genuine examples where a company will own a significant freehold asset. And I think and the second bullet here goes on to talk about this under what will qualify. So if things they're looking out for, things that they believe that the EIS should be used for, and what a company should look like, is they use words like independently run. So that sort of counters the actual fund management control piece we talked about earlier. Ambitious growth targets. So companies that are targeting returns which are commensurate with high risk. So typical returns of more like 2-3 times investors' money over, again, a longer period of time. They recognise that these growth businesses, high risk businesses, they take time. The idea of exits after 3 years are, for the most part, a rarity and slightly fanciful. It's normally a truly high risk, high growth business takes 5, even 7 years to realise its ambitions. A company that engages in wealth creation, employment creation. So it is a company actively looking to take on new employees and grow its employment base, which again is to them is a signal of a business which is growing and contributing. So as I go on to say here, even with the evidence of substantial assets, so they gave examples here of a independently run freehold pub restaurant business. So it may have freehold pubs, but it's the most of the risk is not attached. It is attached to the trade. So the property, it may be a freehold property, but it's truly an independently run business. It's truly a new business. It's truly creating lots of employment. It's not a 5 million raise with 4 million going into a freehold asset, and quite frankly, the operation of the pub or restaurant is incidental for 3 or 4 years, just to unlock the longer term property value after that period. So this is the kind of things they're looking at. Another example they gave was life sciences. So again, a company which is carrying on R&D in the life sciences sector, but wants to basically either acquire or build out and develop an R&D facility. Again, clearly, it's a business which is subject to risk. Most of the money is going on drug discovery, and the actual R&D facility is incidental, is part of the business plan rather than fundamental to the business plan and return to investors. And the final example they gave was an independent film production company carrying on the true development of production assets, where those assets are subject to risk, that they're not backed off with tax credits or pre-sales. So it's just turning to the next slide, just to continue this piece around the risk to capital. So what does this mean for the future of media and asset-backed offers? Well, I think as we currently stand, the capital preservation structure, it just simply will not be allowed after the Royal Assent, as we said in 2018. I think, moreover, that those companies that are seeking advance assurance now from HMRC, which fall into this category, will not be granted EIS advance assurance. So what HMRC is saying is, as from this Friday, they will be minded not to give EIS advance assurance to companies where they believe that they don't pass the capital to risk condition. They believe them to be capital preservation structures. That'd be a problem for investors and retail offers if they can't give those investors some kind of assurance, the EIS assurance that their investment will qualify for EIS relief down the line.
I think there's a real issue in media with the actual pre-sale. So typically these schemes, 70% of the capital preservation is made up of a combination of pre-sales and production credits. And effectively the way it operates at the moment is that the investor is cash flowing the production company, providing the production company with upfront finance to start the film, and to go out and secure pre-sales, and at the end, when the production is finished, to get the production credit. Now, what's clear, I mean, the numbers are usually about 50% is made up of pre-sales and 20% of production credit, totaling 70%. The remaining 30% is clearly entirely risk, so there's no problem with that. I don't think there's any problem with the production credit either. That's definitely 20%, and that definitely will not qualify going forward. I think the pre-sale element is definitely a grey area, and I think it's going to be very difficult to legislate, because it's quite possible to invest in the production when at the time you make the investment it doesn't have any pre-sales. It goes out and subsequently to issuing shares, it goes out and successfully negotiates pre-sales. So is HMRC going to operate retrospectively? Are they going to have a look back to see whether there have been any pre-sales or not? So it's unclear to us how that's going to work. We think it possible that the pre-sale part, provided it's not been entered into at the time the shares are issued, the pre-sale part might survive, but it's not at all clear at the moment.
I think the message is very clear, though, that clearly companies will, at a time of advance assurance and post investment, will have to clearly be at risk. The capital will have to be at risk, so that the capital of EIS money will have to be deployed against what is called the gap, the unprotected part of a film investment. So other tranches of production credits, things like tax credits or pre-sales HMRC are clearly looking for that element of funding to come from the banks or alternative sources of funding, not from EIS money. So this is something they will look at, as I say, at the advanced assurance stage. They will probably look at it very carefully. A year, 2 years down the line, once these companies start to produce published accounts, and they reserve the right to ask those questions. Even at the EIS 1, EIS 3 stage, they may ask the questions again once money has been deployed and the trading commenced. So clearly, for the industry, you're going to have to look out for these kind of things. So just to sort of finish on this slide. This will apply to obviously freehold assets as well. So again, just to sort of hark back to the previous sort of 2 or 3 slides, at the time of advanced assurance, the boards of these companies, the product providers that are investing in these businesses with retail money are going to have to prove to HMRC at advanced assurance that yes, if there are freehold assets that are apparent, that they are incidental to the overarching trade, target returns and risk of the business. That the business is truly there to create growth over the long term, and that the freehold asset is there to facilitate that rather than to be front and centre of the whole investment proposition. And as I say, there are examples of that where clearly the trade is more of a holding pattern to unlock value of the freehold asset after 3 years. They will be on the lookout for that kind of structure.
We'll stay online for another 5 or 10 minutes, and we'll be happy to try and answer any questions you may have. I hope you found this interesting, educational. In general, as I said at the beginning, I think this has been a hugely positive budget for the EIS and for all the schemes within the grouping of tax advantage schemes. I think a lot of it was down to the efforts of the EIS Association, who mounted a very effective lobby of the Treasury, and the Treasury has listened. So I think there's been a great desire on the part of HMRC and Treasury to cooperate with the industry. So the industry basically is saying, yes, we need to clean up our act, and let's work together on finding a way to do that. So I think it's been an extremely positive exercise.
Okay, so we have a first question in, and the question is, do you consider that there is any risk of HMRC revisiting advance assurance for companies engaging in media pre-sale type trades where advance assurance has already been granted? So I think to answer this, first of all, is to say that an advance assurance from HMRC is not a binding agreement on HMRC's part. Therefore, they do reserve the right at the time a company goes to apply for the EIS 3 certificates on an EIS 1 form to even if that company's got advance assurance, to ask further questions around their business plan, around how it operates. Now, the current thinking goes that as long as you've made a full disclosure at the time of the advance assurance and nothing has changed, so you're basically carrying out the business plan as envisaged in that advance assurance, and you divulged all the information to HMRC when seeking that advance assurance, then they can't reasonably withhold the EIS 1 or indeed the EIS 3 certs to investors. Now, but clearly here we are in uncharted territory, and even though a company may have advance assurance and it's in the process of raising money and issuing shares, I don't believe they will, to answer the question directly, I don't believe they will look to come back and revoke the advance assurance or look to open up, supplemental questions into that advance assurance. But I think clearly what we're looking for and the guidance we're looking for, hopefully this Friday or next week, is that when we come to issue shares and apply EIS-free certificates, that they will honour that EIS advance assurance, and as long as those shares are issued and the business plan hasn't changed either way, they will honour that share issue on that date, as long as it's before the date of royal assent, is when obviously the risk to capital condition applies. So I think, in short, no, they won't be revisiting advance assurance for companies that have already got it in the media space. But obviously, clearly, I think the industry is looking for some kind of guidance on, where does that leave those companies that have advance assurance in issuing capital over the coming months, leading up to the end of the tax year and the date of eventual royal assent.
So, anything else? Anybody got any further questions?
Okay, we have another question from just come in. Will the likes of Hindsight Media need to reinvent their business models to a large degree to stay in business in the future? Well, I think clearly, if they wish to raise capital from the EIS or venture capital marketplace, then yes, clearly all media asset managers that utilize EIS or CDIS or venture capital will have to change their business model and invest more in the, as we talked about earlier, the gap, the true risk element that makes up a film or TV or media production, the money at risk. So that is very clear, and obviously those productions will have to get their capital for things like production sort of credits and pre-sales from alternative sources. The legislation currently, or the guidance currently drafted, does say that, and HMRC do recognise that some EIS venture capital money will go towards things like production credits and pre-sales, but clearly they're looking to the model to be inverted, where I think it's fair to say that currently 70 to 80% of the money is going towards pre-sales, production tax credits, etc., and 20 to 30% is going on true risk. I think they're looking for that model to be inverted. But again, I think that's going to become clearer over time in how that particular industry adapts.
I think media is absolutely the hardest. So it's going to be very interesting to see how we go with media. I think it may well be possible to come up with a new structure which does pass the test with HMRC in the future. It will be more risky. The big question is whether it will be sufficiently attractive to the investment market. So that's, I think, where the jury is out at this point in time.
It would be a new investment landscape for EIS venture capital media, where they'll be looking for the business plans to be of higher returns, higher risk, longer term. And it's, as Martin says, investors and I think the advised market are going to have to reset expectations that investors will be taking on more risk, but for more return. I think we've got another question that's come in, which reads: do you think this spells the end of the EIS fund? So I think this question is alluding to wording that was released last week in the draft guidance that talks about fund, and I think we talked about it earlier in our slides, where the fund manager is able to operate a fund via nominee and not only use their discretion in the underlying investments, but also have the legal power on behalf of shareholders to drag and vote through exits, when the exits happen, at what price they may happen. Now, I think clearly that's something HMRC don't like. So I think we will see that removed. So the actual ability for yes, a fund manager will have the discretion to invest money, but the ability for them to call the shots in terms of the timing of an exit and the quantum of an exit and how investors' returns are capped, yes, we will see less of that. I think that. But having said all of that, not to say that EIS funds won't exist anymore. And as I said, HMRC will look at this test in the round. They will consider all the factors. So clearly, a fund that has a fund manager that invests in underlying life science companies, media companies, or indeed bar, restaurant, leisure businesses that is taking long-term risk for high returns for investors, and is clearly creating employment and potentially creating wealth, will qualify. I've no doubt about that.
What I was going to say was, I think early exits are a thing of the past now, because I think early exits are determined by where a fund manager says at the outset that they're going to wind the company up after 3 years and 2 months or whatever it is. They're going to seek an exit to the earliest possible date. And I think HMRC do not like those at all. I think they think they're artificial and engineered by managers. So I think they are for the chop. It's going to be very difficult to do early exits. So I think, to answer the question, I think funds will still exist, but they will be very constrained in how much influence they can bring to bear.
Yeah, and early exits may come about for all kinds of reasons. Again, if it's in the normal course of business, so a company does spectacularly well after 2 years into its business plan, even before the EIS qualifying period is over. And if an offer comes from a trade buyer or a private equity buyer, very rare, then obviously that offer may be accepted by the shareholders, and obviously they lose their relief. Clearly, and it could come after 3 years after qualifying period, but I think the point is this is kind of engineering via the fund manager, as Martin alludes to, where it's almost like it's after the 3-year qualifying period is over, there's some kind of liquidation event by the sale of normally a large asset, and then funds returns tax-free to investors that HMRC are clearly on the lookout for or don't like.
Any more questions then, or are we done? I think it looks like we're done. What do you think? Anybody else want to ask anything? Last chance. Okay, well, let's wrap it up there. Thanks to everybody for joining us this afternoon. I hope that was useful. Please be in touch by phone or email if you want to pick up on any of these points this afternoon or later this week. We look forward to being in touch with you all very soon. So thanks very much again. Bye-bye.
Bye.
Bye.